We're now moving on to Chapter 3, and we're going to talk about annuities, which are quite different than segregated funds. So let's first of all talk about what an annuity is. Many people have heard the term, but when I say what is an annuity, people kind of struggle about, gee, I really don't know how to define it. But very simply, an annuity is a series of payments. When you retire and you start receiving your pension is in fact an annuity. It's a series of payments that's paid to you most likely for the rest of your life. Some could be for a specific term, but an annuity is a series of payments. And what happens is you enter into a contract, usually with a life insurance company, and you give them a chunk of money, and they say, with this amount of money, here's how much we can pay you per month for the rest of your life. Or you might say, I want to buy a 10-year annuity. They say, here's how much we can pay you every month for the remaining 10 years. So it's a contract between an annuity provider, which is usually a life insurance company, and an investor. So the annuitant is the person on whose life the annuity is based. And so when you go to a life insurance company and they say, oh, I want to buy a life annuity, and you say, oh, I want to receive $2,000 a month for the rest of my life. Life insurance companies, because of the statistics they have, they're able to estimate how long you are going to live, how long they're going to have to make those payments, and based on today's interest rates, they can then determine how much money they're going to charge you up front in order for you to buy that stream of annuity payments. So every payment you receive from an annuity is a combination of a return of some of your principal, some of the money you put in, and some of it is interest. So each annuity payment, portion is principal, portion of it is interest. So the payment is a combination of those two amounts. There are guaranteed annuities, and so the insurance company will guarantee you a stream of payments for the rest of your life. Once you've made that commitment and you've said, okay, here's my deposit, they're going to guarantee for the rest of your life you're going to get X number of dollars every month or every year, depending on what you select. So that's a guaranteed annuity. So the payment and the interest rate is fixed at the time you make the purchase and doesn't change. A variable annuity is something where the payments are in fact linked to the stock market or linked to a segregated fund, as an example. So you might say, oh, I want to receive $2,000 a month, but I want you to take my principal investment and invest it in these 3 segregated funds. And so instead of having a guaranteed return in your annuity, you may have your principal invested in a segregated fund that's increasing or decreasing in value along the way. So there are guaranteed annuities and variable annuities. Now, one of the issues you have obviously with an annuity is, first of all, they're pretty simple to understand. And so for the average person, we say, give me a chunk of money and I'm going to pay you so much a month. Pretty easy to understand. You don't have to make any more investment decisions. You're locked in that decision at that point in time, and you're going to get this steady stream of income for the rest of your life. So a lot of people that are retiring want to make sure that there's at least X number of dollars coming in each month to cover grocery bills, hydro, and whatever living expenses are. They may take some of their retirement funds and purchase a life annuity. So it gives them X number of dollars religiously every month. They're going to continue to get that payment for the rest of their life. So they have a steady income stream. They don't have to worry about making any future investment decisions. They don't need to monitor how that annuity is performing. Everything is guaranteed and it's locked away. Now, having said that, that gives us some of the disadvantages of an annuity. Once you've made your decision on an annuity, it's locked away. You cannot get your money back out later on because the insurance company has taken your money, invested it in a long-term investment to be able to generate those monthly payments that you want. So you lose some flexibility in that you've given up the ability to get at your principal. It's already locked away. And in addition to that, you're going to take interest rate risk. Remember, we talked about different kinds of investment risk. We are going to take interest rate risk if we invest in an annuity because our interest rate is locked away at the date that we make the purchase. So if interest rates go up in the future, you're not going to be able to take advantage of that. Conversely, if interest rates go down, you're going to be at an advantage because you've got a higher rate than new people are coming into the plan can get. So some advantages, some disadvantages about annuities. There are different types of annuities. We have something called an immediate annuity. An immediate annuity says, if I give you this chunk of dough, I want to have my monthly payments start immediately. So start my payments right away. This is called an immediate annuity. We also have deferred annuities. A deferred annuity says, here's my deposit, but I don't want to start receiving income yet. I will let you know when I want to start receiving income. And while you're holding my deposit, insurance company says, no problem, we're going to pay you a certain level of interest on your deposit until you decide you want to start receiving that income. So that is a deferred annuity. So the start of the annuity is deferred until the date you tell them you want it to start. Immediate annuities, payment starts right away. Deferred annuities, we defer the payment until you let me know. In addition to that, we have got two types of annuities in terms of how they are the term of these annuities. We can have a term certain annuity. So you can say, I want to receive payments for 20 years. And so they'll calculate that and you will receive a payment for the next 20 years. At the end of the 20-year period, no more payments are payable. The annuity is terminated, everything is done. This is a term certain annuity. So it's an annuity for a specific term. We also can buy a life annuity. A life annuity says, oh, I want to receive the payment for as long as I live. And so as long as I live, if I live 5 years, great, I keep getting payments. If I live 25 years, I keep getting payments. So a life annuity lasts for the lifetime of the annuitant. We can also have an annuity on more than one life. We can have a joint life annuity. So myself and my spouse, we could have an annuity on both of our lives, and that annuity says, pay us $2,000 a month as long as we are both alive. So we start receiving $2,000 a month. One of us passes away, the other one is still alive. Those payments will still continue until that individual passes away. So that is a joint life annuity. So we can have a single life annuity or a joint life annuities. Now, where can I buy an annuity? Well, I can buy life annuities, joint or single life, only from life insurance companies. I can buy term certain annuities from life insurance companies, but also from other financial institutions like banks. And the reason for that is that a term certain annuity has nothing to do with any mortality statistics, because it's purely an investment for a fixed term. Whether you're alive or dead, those payments are going to be made. And so life annuities, because they involve the use of mortality statistics, they can only be issued and offered by a life insurance company. What affects how much I get in my annuity? In other words, the insurance company is going to have to do some calculations to determine how much they are going to pay me in my annuity. Remember, I'm giving them a lump sum amount of money, and they're saying, based on the amount of money you're giving me, I'm going to be able to pay you so many dollars per month or per year for the rest of your life, or for this specific term that you selected. So what affects our annuity payments? Well, first of all, it's going to be current annuity rates, current interest rates in the marketplace, because the insurance company is going to take your money and invest it today. So obviously if interest rates are low, they're going to lock in a low interest rate for the rest of your life. If interest rates are higher, then you're going to lock that higher rate in. So the annuity rate, that you amount of payment, monthly payment you get, is directly related to today's level of interest rates. Second thing, age and gender. So the older you are, the higher likely your annuity payment is going to be, because the number of payments they're likely to make are going to be fewer payments than if you were a younger person. Gender also impacts annuities. Females outlive males, so in general, for the same amount of a deposit, females will receive a smaller monthly amount than males, simply because they live longer, and so we're going to make payments to them longer, so the amount of payment is going to be a little less than for a male. So age and gender does impact on life annuities. Age and gender has no impact on term certain annuities, because term certain annuities have nothing to do with mortality. Okay? So in addition to that, you get usually a better rate for larger deposits. I guess it's a bit of a discount for volume. And so if you buy an annuity with $50,000 as your deposit, you're not going to get as good a rate in the calculation as if you gave them $500,000. So there's a better rate for larger deposits. Payment schedule, well, you can receive your payments at the beginning of the period, or you can receive it at the end of the year, one payment, or you can receive it monthly. And so you have the flexibility and the choice to pick when you want to receive your money. And in addition to that, obviously, the length of the payment period will in fact impact how much you can get paid. If you said, oh, I want to receive payments for 10 years, you're going to get more than if you want to receive payments for 20 years. So the length of the term of payment will also impact how much you're going to be paid on a monthly basis from that annuity.